Imagine you want to know how well all the bakeries in your city are doing. You could go to each bakery and ask for their sales numbers. That would take a long time. A stock market index is like a shortcut. It tells you how a group of companies are doing overall. Instead of tracking every bakery, you could look at a bakery index. This index would track the performance of a select group of bakeries in your city. If the index goes up, it means the bakery business is doing well in general. A stock market index tracks a group of stocks. These stocks are chosen to represent a particular part of the market. Just like the bakery index, a stock market index going up means that part of the market is doing well. Stock market indices are important because they give investors a quick way to see how the market is doing. They can also be used to compare the performance of different parts of the market. For example, you could compare the performance of the tech index to the energy index. Let's go back to our bakery example. Imagine you have 3 bakeries in your bakery index: Sweet Delights, the Breadbasket, and Cakewalk. Each bakery has a different number of stores. Sweet Delights has 10 stores, the Breadbasket has 5, and Cakewalk has 20. If we simply average the sales of each bakery, Cakewalk would have the biggest impact on the index because they have the most stores. That wouldn't be fair to the other bakeries. To make it fair, stock market indices use something called a weighted average. This means that companies with more shares have a bigger impact on the index. Just like our bakeries, some companies are bigger than others. There are different ways to calculate a weighted average. Some indices use the company's price as the weight. Others use the company's market value. The method used depends on the index. Just like there are many types of bread, there are many types of stock market indices. Some indices track the entire stock market, while others focus on specific sectors or countries. One of the most well-known indices is the S&P 500. This index tracks 500 large companies listed on stock exchanges in the United States. It's like a best of the best list for American companies. Another popular index is the Dow Jones Industrial Average, which tracks 30 very large companies in the US. You can also find indices for specific sectors like technology, healthcare, or energy. These indices can be helpful for investors who want to focus on a particular part of the market. For example, if you think electric cars are the future, you might invest in a clean energy index. Why stock market indices matter: a tool for everyone. Stock market indices are important for investors, economists, and analysts. Investors use indices to track the performance of their portfolios and to compare their returns to the market. They can also use indices to research different sectors and countries. Economists use indices to track the overall health of the economy. A rising stock market is often seen as a sign of economic growth. Analysts use indices to research companies and to make investment recommendations. Think of a stock market index like a thermometer for the economy. Just like a thermometer tells you if you have a fever, a stock market index can tell you if the economy is heating up or cooling down. Section 5. The limits of indices, not the whole picture. While stock market indices are useful tools, they are not perfect. It's important to remember that indices are just a snapshot of the market. They don't tell you everything you need to know about every company. For example, a company might be included in an index even if it's not doing well financially. This is because indices are based on size and other factors, not just performance. It's like judging a bakery only on its number of stores, not the quality of its bread. Also, remember that past performance is not always a guarantee of future success. Just because an index has gone up in the past doesn't mean it will continue to go up in the future. Section 6. Conclusion. Your guide to navigating the market. Stock market indices are like roadmaps for investors. They provide a valuable tool for understanding market trends, comparing performance, and making informed investment decisions. While they have limitations, understanding the different types of indices and how they work is essential for anyone interested in the stock market. Remember, investing in the stock market always carries risks. But by learning about indices and doing your research, you can become a smarter and more confident investor.